The AI party may be in full swing, but one of the attendees may have overindulged a bit. We'll take a look at a high-flying semi that looks a little tipsy, and sometimes it makes sense to rent before you buy. We're going to look at a way to do exactly that in United Rentals today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic. First, I must apologize. Normally this would be a live stream, but due to a scheduling conflict, CNBC has asked me to be available. I had to record this early, so unfortunately I won't be able to respond to your questions or comments live, but please be sure to leave them anyway, and I will try to address them on a subsequent video. A couple months ago, AMD CEO Lisa Su said that the AI industry could reach $400 billion by 2027. More recently, at the Morgan Stanley Tech, Media, and Telecom Conference, she pointed out that increasingly a $1 trillion number is bandied about as folks describe the scale of potential AI investment. Unsurprisingly, with this as a backdrop, several tech companies associated with AI have seen their share prices take off, most notably NVIDIA, whose GPUs are best in class, and Supermicro, which designs and builds blade servers with specialized cooling to accommodate them. AMD also jumped on the bandwagon, as they are seen as a key beneficiary of big cloud providers continuing to fuel the server market. Microsoft, Amazon, Meta, Dell, and Alphabet represent nearly 11% of AMD revenues. More exciting to investors might be the launch of MI300 GPUs, which are seen as a potential challenger to NVIDIA. Revenue growth is expected to accelerate to 20%, and while that is very good, of course, that is considerably less than the more than 100% growth NVIDIA has seen over the past 12 months, or the more than 100% growth analysts estimate Supermicro will show when they report their results in the coming months. At 50 times full-year earnings and 11 times full-year estimated revenues, AMD isn't cheap. And while metrics like these that are used in fundamental analysis give some perspective, they're not really an exceptional timing tool when it comes to trading. And so for that, we want to look at technical or sentiment indicators. And in AMD's case, we got quite a bad one on March 8th, when the stock gapped higher to new all-time highs before closing lower, a so-called downside or bearish reversal. Not positive, and the stock has underperformed the market and other AI names since. So looking out to earnings, which are anticipated by the first week of May, depending on the source, some are saying it's going to be the last week of April, others in early May, I think we can consider using some of the strength that we're seeing in the stock today to sell an upside call spread, which is a neutral to mildly bearish position. And I was looking at the April 185-190 call spread, selling the 185 calls at 840 and buying the 190 calls, paying $6.45 and collecting a $1.95 credit. And maybe we can just take a quick look over here, and I'll use the Options Play app to do this, so we can see what that would look like. And so here we can see what the trade looks like. Has about a 60% probability of profit by our work. Quick point, when I'm selling call spreads, I would like to collect at least 30% of the difference between the strikes when I can. And notice that the expiration I've chosen, April, is not expected to cover the earnings, as I just pointed out. Generally speaking, that is when most stock volatility is going to take place, when you have something like earnings coming out. And getting net short options isn't a strategy I particularly favor in that case. Or at the very least, if I do, it's with a fairly specific price target in mind and some buffers. That's why you'll often hear me talk about things like call spread risk reversals or put spread collars and things like that going into events where you are net short more options because you would be selling two wing options and buying it at the money. But the whole objective there is to try to get participation close to spot through some target price, whereas doing things like selling covered calls or call spreads or put credit spreads is probably less advisable when a stock is really propelled to move. Okay, so with that out of the way, we'll move on to United Rentals. So United Rentals is headquartered in Stamford, Connecticut, and it's the world's largest equipment rental company. And it is also one of the past decade's most impressive earnings growth stories. growing adjusted EPS from about $4 a share in 2013 to over $31 a share for the full year ended December 31st, 2023. That's a 670% increase. And that kind of growth, if it is sustainable, justifies a well above market multiple. But interestingly, at just over 25 times earnings, URI is only trading at a small premium to the S&P 500 right now and its own historical multiple. According to a recent Deutsche Bank research report, United Rentals operates in attractive end markets that are experiencing tailwinds from mega projects, which are expected to provide a multi-year boost. The only concern for those interested in purchasing United Rentals right now is that things have perhaps looked a bit too good. Having jumped nearly 13% after they reported earnings on the 24th of January, the stock is now up about 95% over the past 52 weeks, so an investor could be forgiven for thinking they're arriving a little bit late to this party. So perhaps we can take a cue from the company's own business and rent before we buy. And one way we can do that is to take a look at essentially a poor man's covered call. So here the company is expected to report earnings on the 26th. And so one of the things we could take a look at is capturing an earnings call option that captures those earnings. So why don't we just go again over to the application here. Okay. And we will try to buy a call option that is on the long side, that is to say that expires after that anticipated earnings release. So I'm just going to go in here and just choose May options. Stock's trading a little over $700. It's down slightly today, so we're going to try to take advantage of today's weakness. Maybe we could buy the May 710 calls, which are just out of the money. And then we're going to look to sell a nearer dated option against it. And just to confirm, I'm going to see what Bloomberg has as the earnings. Bear in mind that there have been a lot of differences with respect to when some of these earnings are coming out. They have it for the 26th. Taking a quick look at options premiums to see how those are pricing it. Those also appear to show the 26th. So one of the things we could do is look to sell maybe just a regular way April option against that to help finance the cost. And I'm going to do a diagonal here. So we own the 710s. Maybe we can sell, oops, I don't want the April 26 because those capture. So it's these ones, these regular way ones that I'm actually looking for. Okay, so here we go. So again, buying the May expiration 710 calls, those are expected to capture earnings, and the options market definitely is pricing that in. So there's, like I said, some difference of opinion over when these earnings in many cases are expected. As I've mentioned before, I think that could be a function of the fact that this is a leap year, so some of the algorithms that do that work automatically have been miscalculating. But April 19th definitely does not look like it is poised to include that. And one of the things you'll notice here is that you actually collect a pretty good portion of the premium that you're spending to buy those 710s by selling these 730s. $40 and $15, give or take, are the numbers that I'm seeing right now. So you'll get a payoff that looks a little bit like this. So the total net debit in this case, $25 per share, $25.20 because each contract represents 100 shares. That versus $70,600, which is what it would cost to buy 100 shares of URI right here. And the idea is that essentially the near dated option is going to pay the decay, and you'll get essentially a standstill rate of return that is flat to maybe even slightly positive. Maximum downside loss that is just a percentage of the current stock price. And we may get an opportunity to reload depending on how the stock behaves. So this is an important thing that as you look at this trade, just bear in mind that when this expiration comes about in April 19th, knowing that earnings are coming up, and by that time the company will have reported or at least released when they are going to be reporting earnings. So go to the investor relations website and see exactly what day it falls on. If it's going to be after the 26th, we might have an opportunity to stay in those Mays and then write the subsequent weeklies on the 19th or thereabouts and roll those out. So that can be a good strategy. This is essentially, I call this renting the stock because it's also sometimes called a poor man's covered call. You could go further out in time, but these are some pretty chunky premiums. But this is a way to essentially get into that kind of a buy right situation without taking a full-on downside risk by purchasing the shares. As we can see here in this P&L, that it basically levels off to the downside if the stock falls. So we're defining our risk on that one. Okay, that's all I've got for today. I apologize for the abbreviated program. Please be sure to like, subscribe, all that kind of good stuff. Do leave your comments. We do look at those comments and we will try to incorporate them in a future video. Thank you very much for watching.